Hey, everybody. Welcome back. It is actually week 135. And I know that I was out last time and Adam thought it was week 137. That's in 2 more weeks. So, but it's in the 130s. Oh my goodness. And we have let Jack off the hook today because he felt like he needed to be at some sort of industry boondoggle somewhere in the United States to, show how smart he is and get new business and all that. And he'll be very good at that, I'm sure. So anyway, we will miss the fun and frivolity of Jack and all his current events updates. So we're going to be pretty light on the updates because, we don't have Jack. And I'm not going to give out any Shoemaker Starbucks cards because I need to have him give them out. So stay tuned for that. So it's just me and Adam, just the OG guys from 135 weeks ago. So we're going to go ahead and start and talk about, all right, so what should we be doing to finish 2022 strong, moving into 2023, really kind of from a tax planning standpoint. Some of the stuff that has come down from a legislation standpoint early in the year, we said, it looks like this is coming. And then certain things got roadblocked, other things got moved, and other things are moving forward. So I think that would be good. And Adam is in beautiful Oklahoma. So I want you guys to be thinking about Oklahoma, where the wind comes sweeping down the plain. So think about that, because he said that he was going to turn the camera to look out the window and see the 35-mile-an-hour winds, which are very common in that part of the country. So I'm glad you're inside and safe. Adam, it's good to have you here. Take it away, buddy.
All right, cool. Well, I appreciate that, Gary. It's funny. Every time that I'm here, my mother-in-law always likes to tease me with that scene out of Dirty Rotten Scoundrels, where Michael Caine and Steve Martin are sitting at the table, and Michael Caine says, "We're moving to Oklahoma, Riprick. Oklahoma, 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 Oklahoma." And then, she gets me a fork with a cork in it, and I poked that in my eye a few times. And anyway. If you haven't seen that movie, it's actually it's a pretty funny scene. So yes, be here for a couple more days, but happy to do this.
Awesome. Well, we already got one question, and then I know you can take it to some additional stuff, but Derek was like the early bird that hit the worm. And so you beat out Robert Mayetta. So kudos to you, Derek. So here's the question. What advice are you giving around year-end planning, thinking 179 stuff, and advice for 2023? Great question.
Yeah. So, couple things to be cognizant of, because they're all somewhat related from a planning standpoint. When the Tax Cuts and Jobs Act passed back in, I believe it was 2017, remember there's the Byrd Amendment, I believe is what it is, which basically says, hey, this crap's got to pay for itself somehow. So it's always interesting when they do tax cuts, they've got to project out what's going to happen. And everybody always says, it's going to be revenue neutral, or it's going to raise revenue. When they're talking about revenue, they're talking about, receipts into the federal government. And, one of the things that I like that Senator Byrd did is that, that the common theme is that, hey, if I give a tax cut, that's going to incentivize more spending in businesses, which means that they'll grow, and then GDP will grow, and then I'll have more tax receipts that come into place, and that's what's going to pay for this tax cut, which is a reduction in revenue. And history has kind of proven that, with the exception of the tax cut that happened around Reagan, which was a temporary blip when tax rates were at 80% at the top marginal rate, that a tax cut doesn't really foster long-term economic growth as much as we would wish and hope and like it to. Now personally, as a taxpayer, I freaking love it because more money in my pocket. That's great. But in terms of having it play out into actually increasing revenue, it doesn't really happen. and you kind of just look at history. That's all I'm asking. Look at history. So what they did a while back is they just said, look, this is all good stuff. And it was actually, I think, happened right around President Bush's time with the Medicare prescription drug benefit and the tax cut that President Bush did. A Republican senator stepped up and said, this crap needs to pay for itself somehow. And if it can't pay for itself, then this crap's going to expire. So that's a long way of saying that in the Tax Cuts and Jobs Act, two of the things that were very nice that we're enjoying a lot of now that are due to phase out and expire because the Tax Cuts and Jobs Act has not paid for itself are the depreciation rules, which means that they're rolling back. They're not going to be, you still get to depreciate property and equipment. You're just not getting it all up front, which impacts the Section 179 going down, bonus depreciation, going down. That's all within the next couple of years. And then the big one is that in 2026, the qualified business income deduction goes away and tax rates go up, which effectively means that for most of our clients, which are S corporations and partnerships, that's going to be about a 10% tax rate increase. So my point in saying all that, to answer Derek's question, now that I've spent about 15 minutes killing time for you, Gary, just kidding, is that, yeah, it's kind of same as always for equipment purchases, which is if you have something that you were otherwise going to buy or use anyway, and you were otherwise going to buy and use it within the first 3 or 4 months of the next calendar year, you might as well pull that back into this year because, we don't really see tax rates going up in 2023, at our client base level. I mean, it just you'd have to have a combination of massive Democratic sweep, in the House and the Senate, combined with, people like Joe Manchin and Kristen Sinema just suddenly saying, oh, hey, we were against all this stuff, now we're for it. And I don't see that likely to happen. So I think, the worst case scenario for a business owner was the Senate tax bill that passed, which we covered pretty extensively at the beginning of this year. And if you guys will remember from our commentary, that wasn't horrible. At the end of the day, it represented about a 2 to 3% rate increase for our typical client. And if that's the worst that it's going to get, I think that we're probably in pretty good shape in 2023. So, what you want to keep your eyes on are, while the depreciation rules are still favorable, go ahead and accelerate the purchase of stuff, because it is a time value money equation when the tax rates aren't, probably going to go up in 2023. And then, secondly, just be keeping your eye on the radar that, 2026, and again, that in 2026, just to remind everybody, that isn't there'd have to be an election and Congress would have to, pass some legislation and blah, blah. It actually would result in Congress doing nothing. Like it's just going to happen. Like unless somebody takes a proactive step, it will happen, period. So I think if you generally feel like Congress has their crap together and is generally good at passing bipartisan legislation, then you can probably count on that they'll get together, Democrats and Republicans and do the right thing and do something about, fixing the U.S. tax code. If you did not detect the sarcasm in my voice, let me be clear. I'm betting on they're just going to let it expire, and blame each other, and we're all going to face a tax rate increase in 2026. That is my prediction. Or alternatively, Democrats will let it expire, but they'll set the bar pretty low to where maybe $400,000 AGI, which is what they kind of target, as their number, won't be impacted. Or, if it's Republican control, they'll let it expire, but give you a 1% rate decrease and claim that they gave you a tax cut when really they gave you a tax increase because they took something else away. Is my best prediction. But for right now, we're pretty safe.
All right, we've got some good questions rolling in. So Matt says 3 of my 5 adult children have student loans. Do they need to make application for forgiveness or will it be done automatically? It seems stalled now, but they were getting mixed advice.
You're supposed to be applying so that you're at least in the queue, even though it's sitting in court right now, getting challenged.
I also heard that some checks have been going out, but I think that was for people that paid during the pandemic, during the pause or something. Do you know anything about that?
I would have thought that's not the case. Like that would be shocking to me that any check got sent.
Yeah, I was shocked.
I don't know that for a fact, but that'd be shocking to me.
Yeah, I don't know.
Because I mean, it was pretty.
It was Fox Business.
Yeah, but I mean, if you think about it, like that'd have to be the most efficient thing the government ever did because, Biden passed it as an executive order. They started the application process. It got challenged once, was allowed to move, got challenged again, and it was put on pause. That all was within 60 days, I believe. So that would be amazing to me if it moved that fast. Maybe 90 at the tops.
So before we move to Robert Mayetta's question and what he's looking for, Matt, you are kind of filling the gap for Jack being gone. I think this is pretty funny. So here's the logic. If pro is the opposite of con, is the opposite of progress Congress.
That's
really good.
That's pretty funny. Matt will be here all week. Tip your waitresses, folks.
That's pretty good, Matt. I like it. Yeah, we might have to call you in on being a stunt double for Jack when he's out of town. Okay, Robert, here's the question. Looking for economic wisdom. Well, you have got the right guy, Adam Bozeman. Why does the Fed not just sell off $8.5 trillion from their balance sheet to push up long-term rates and slow the economy by pulling money out of the system? We appear to be moving faster on increasing short-term rates than this other option of reducing money supply.
Yeah, as always, Robert, it's like, you're one of my favorite guys at the hey, what if we were in charge? Things. And unfortunately we're not. So I'm with you that I believe that the current strategy of raising borrowing rates is probably not the dumbest thing that I've ever heard, but is up there in terms of resolving the crisis at hand. Like I'm struggling with like how raising my short-term interest rate is somehow going to get more semiconductors manufactured to solve a supply side problem. So it's stupid. Anyway, thanks, Robert.
It's definitely taken its toll in the construction world, and I'll not use names, but a pretty high up person in the National Building Association, I think that's the association, one of the biggest commercial, or not commercial, but basically tract home builders in the country. The word to their land people, or their land development people, was in November, shut it down and grass everything that has been cleared. And another massive one said they're cutting back, and when they were looking at 600 lot home developments, they're taking them back to 100 to 200 at the most. So the interest rates are definitely impacting that. Ask Movement Mortgage or anybody in the mortgage industry, or anybody trying to sell houses right now too. So it's and we're fortunate to be in a part of the country where people still want to move to it, et cetera, but it's an interesting thing. So Derek chimes in, you can apply on the FAFSA website. So thank you for addressing that. That goes back to Matt's question. Appreciate that. Also, then Matt comes back and says, know anything about HVAC and CER/SEER efficiency rules? Need to update units and heard that much better incentives are coming out for high efficiency units. So you think we should wait till spring 2023? Question mark.
I mean, you've got some that extends existing programs until 2032. So, you could wait a little bit longer if you wanted to, but they extended what was already in place through 2032 as part of the Inflation Reduction Act, as part of the energy policies. But I think, can I go back to Derek's original question? Because he hit specifically on section 179, but I wanted to hit at some higher level things to be thinking about too. I mean, this really applies, it's the end of the year, but it really applies to the whole year. You ought to be thinking about this at least once or twice a year. The most common question that we get asked, Gary, when it comes to, taxes is, hey, I'd like to pay less. What can I do? What should I be doing that I'm not doing? And the answer to that question is, first and foremost, are you deducting everything that you're legally able to deduct? And, from that perspective, if anybody remembers the book Rich Dad, Poor Dad, written, I think it was written in the 90s. I mean, regardless of whether you think Robert Kiyosaki is the greatest guy on the planet or he's a flim flam guy, doesn't really matter. The concept of, hey, if I have the ability to buy something pre-tax, isn't that way better than buying something post-tax? Is correct. And, the idea of is if when I go to sell my business, will this detract from business value? Remember that what is ordinary and necessary for the purposes of calculating an EBITDA add back for owner fringe benefits when I go to sell my company and value my business, that is completely separate from, is it ordinary and necessary for the purposes of the tax code? So, not, even though it's been out there forever, and if you go to the vault, which I'm sure Gary's going to be great and post a link to, in the chat, we have a whole section on allowable owner fringe benefits. That it's funny, like these aren't even like, super secret loopholes. Like if you Google IRS non-taxable fringe benefits, one of the first hits you're going to hit is the IRS website, where they tell you what the non-taxable fringe benefits are. So you at least start there, So, I think, usually, pretty typical business owner, we can find at least $20,000 to $30,000 of stuff that they should be deducting that they're not currently. And I'm going to tell, when I say it's the most egregious story, it's probably the one where I'm like, man, I don't know if that dog's going to hunt or not upon audit that represents an owner fringe benefit. So, a lot of clients hear us talk about deduct everything that's deductible and then let us sort it out, just let us know what you did. A lot of clients take that to heart, and then forget to ask us the question, hey, is that gonna be okay or not, to get our opinion? They just do it anyway, even though we tell them, hey, do it, but then ask us the question if you think it's a little bit in the gray area. So we had a client that got audited, not related to this owner fringe benefit. It was a wealth management firm that was being audited because the IRS was taking a position on loan forgiveness that was different from what the industry was taking as a position. So they just got flagged, for, hey, you should claim some income that you didn't. That was the purpose of the audit. But when you get audited, they look at everything, right? And we pulled this guy, Chris, I'm not going to use his last name for the sake of protecting the innocent, as the auditor. I had dealt with him in the past with another client who had been audited over mortgage interest deduction and interest tracing rules. And I'd passed the first audit with a separate auditor. Because you're allowed to use your home equity to make an investment and deduct investment interest expense as long as you follow interest tracing rules, which we did. But this guy, Chris, audited this client who'd already been audited and wanted to throw it out again. And I'm like, Chris, he went through an audit 2 years ago for the same issue, and you guys said it was okay. And now you're saying it's not okay. It's like, well, that auditor was stupid. Had to go. So I'm just giving you this as commentary around how strict this guy was that I was up against. So he's auditing the client and looking into travel. And this client was a member of EO, Entrepreneurs Organization. And as part of being an EO, you have to host your forum of fellow CEOs for an annual retreat. So clearly the annual retreat expense would be an ordinary necessary business expense. Like that's a no-brainer. I can make case for that all day long, no problem. Bringing your family along, yeah, I can make a case for that, as long as it's not excessive, like, 7-day Disneyland, fast pass, probably can't get away with that, but 1 day of fast pass because it was proximate to the business meeting. Yeah, I could probably get away with that. So we did all that, right? Well, what this client had also deducted was a scouting trip to the Bahamas, and then a scouting trip to the Keys before finally arriving on his destination for his forum, which was in Las Vegas. So we had 2 trips that were just scouting trips to determine what was going to be the best location for his EO forum, which was not those 2 locations. It was a 3rd location. And I'm like, dude, I don't think that dog, I'll try, but I don't know if that, like, I'm struggling to even make a case for that. It passed. So with one
That's
of the
unbelievable.
and I'm not, and I only use that example to say, hey, that still, even in my opinion, would have been, pigs get fat, hogs get slaughtered, but it still passed. And I'm not encouraging anybody to go out there and say, hey, go hog wild now based on, what I just heard on this webinar. But there is, I'd say within our client base, we're a bell-shaped curve. It's like, we've got some people that are like, dude, that's not kosher. That's the minority, but we've got a good half, and below that could be a little bit more aggressive than they're currently being. So my point in saying that is, the first pass is we have a checklist. If you're a client, ask the person you're working with about the checklist. Gary will post a link to the vault. You can always join in the vault and see our owner fringe benefits that we've got in the Tax Planning Academy. But, take a look at the owner fringe benefits, first and foremost, because in that case, you're just leaving money on the table. You could be deducting something that you're not deducting, and it's basically the 30% discount that you're not giving yourself by taking it pre-tax instead of post-tax. So that's number one. Number 2 problem that we see pretty common that you need to just look at before the end of the year is owner wage. So, as part of the Tax Cuts and Jobs Act under Trump, you get what's called the qualified business income deduction, which is, basically only paying 80 cents on the dollar relative to your taxes. So if you're in the highest tax bracket at 37%, it means that your real realized effective rate is only 30%, or 28.8%, which is great. That applies to your K-1 income. So we always get the question like, well, shouldn't I take a higher W-2 or not? Or what are the rules around that? Again, you go back to, well, what would happen if I got audited? If you got audited, generally in tax court, if you made, $100,000, as long as you're taking at least, 30 to 40% of it in W-2 wage, you're going to pass the reasonable compensation test, because you got tax court cases that back that up all day long. the problem is some of our clients get told early on, hey, 50-50, you know, that's straight up the middle, take 50 of it in wage, 50 of it in K1 distributions. Well, when you're making $2 million, you know, remember that that over $1 million in a C corporation isn't even deductible. So, you know, right out of the gate, you're probably excessive. And what we found is that upon audit, nobody gets thrown in tax court jail for being for being right at the Social Security wage, which is like $146,000. So, you know, for every dollar above $146,000, you're leaving every dollar above $146,000. And for every dollar above, you know, 30-40%, whichever one is the lesser, you are leaving 20 cents on the table. So, but you need to fix that before the end of the year, because otherwise what ends up happening is, you know, we find out about it after the fact. And then all of a sudden we have to go back, you know, you got to amend payroll tax returns. It's just not a good look, you know, versus just switching up your payroll now to get that fixed. So that's problem number 2 that we see. And then problem number 3 that we see is, you know, hey, people are making, you know, pretty good extra cash flow, and they're not doing anything with the company retirement plan, or the company retirement plan is not optimized, meaning they've got a discretionary profit sharing plan instead of a safe harbor plan, which means that they're not getting good employee participation, which means that their contributions are being limited. That's probably mistake number 3. You know, and we've seen, you know, as you've seen, Gary, on our proposals that we do for new clients, I mean, hundreds of thousands of dollars left on the table due to just, you know, in my opinion, it's just kind of sloppy. So those are the big 3 that if I'm doing nothing else, let me check those 3, you know, before the end of the year to make sure that I'm dialed in, because those are all things that you need to do before it. Matt, man, you're winning for the number of questions. Go ahead, Gary.
Yeah, so the question is, I know I can move money into my SEP at Schwab. Can I move part of my SEP out of Schwab into a real estate investment as rental property if I don't manage it?
You know, yes and no. What you can do with retirement accounts is you can set up what's called a self-directed IRA that has the ability to do alternative real estate investment. Schwab will not be able to handle that kind of investment. But if you Google self-directed IRA, you'll get some companies that specialize. I think like Garden and a few others are companies that specialize in doing self-directed IRAs. They're fabulous ways to do real estate investments. But the downside of that, Matt, and for anybody else in the call, is that, you know, if you do real estate investments, or like a lot of people will own own part of their company or part of a company they invested in a self-directed IRA, you know, if that makes money, and when I say making money, I'm talking about ordinary income, like ordinary trade or business income, which would be rental income, versus like I sold it and I had capital gains income. That income is still subject to tax. Like you don't avoid tax. You get subjected to what's called UBIT, the Uniform Business Income Tax, which is just a flat tax. So just, you know, be aware that on the alternative investment, using that for real estate properties as a concept, I love it, but just be aware that you're really avoiding the potential gain. So it's sort of like you're doing a ghetto 1031 exchange that you never have to worry about in terms of that last kick of the can, because all the gains are sheltered because it's sitting in a retirement account. But you do have to be aware that if it actually makes money, you're still going to have to pay some taxes, just like if it was in your name.
Next question, Robert Mayetta. Robert is trying to give Matt a run for his money too.
Yeah, man, you guys are gonna have to meet in real life.
So this is good. With the potential for more small business audits, given the 87,000 more agents, should we be more conservative on our returns, or is consistency a better method?
Yeah, good question. I feel like I already answered this for you, Robert. So maybe you threw that out there for the audience, or you just wanted to see me lose my temper. I don't know which one it was, but so on the 87, because you're seeing that now as part of the campaign ads. Sherry Beasley, she wanted to hire 87,000 IRS agents to screw over small businesses. She's coming to get you. So my response to that is this. One, we're struggling to find people at BGW. What the hell makes anybody think that the IRS is magically going to invent 87,000 freaking people who have accounting degrees that are going to go work as revenue agents? If they found that magic labor tree, I'd love to tap into it so we can hire some people. So first off, do I believe that they're actually even going to find 87,000 people to hire? No, I don't. So that's just kind of BS number one. Secondly, let me tell you what it's like to be a tax professional at BGW right now when you've got an IRS problem that you're trying to resolve for a client. One of my favorite ones was one from the other day, which is, client had their identity stolen. Someone else claimed their refund for 2020. We had to go back, do some amended returns to correct it. IRS hasn't those returns produced a refund carry forward for the client that were trying to apply to their 21 tax bill, filed their 2021 tax return. Now they're getting notices of intents to levy against their 2020 because the 2021 balance due. Why is that? Because they haven't processed the freaking 2020 return due to a lack of personnel. Oh, I know the solution. I'll do the same solution that I would have done in 2019. I'll just call them up, get a whole place in the account. If you aren't on the phone at 7 a.m. in the morning, Eastern Standard Time, you're not getting through. That's never happened in the history of BGW. Literally, you get a message that says, we're too busy, try back later. And even if you're on at 7 a.m., you can anticipate a 3-hour hold time. So that is a long way. And that's for me calling in on my secret bat line that exists, which is the IRS practitioner hotline. I can't even imagine what the normal folk got to do. So that's just BS comment number 2 around this 87,000 tax professionals. So if you can't already tell, Robert, I'm saying keep on being aggressive. We'll be just fine. Thirdly, as we have said before on these webinars, the standard in our business is basically I have to be confident in my answer, and I have to be greater than 51% confident, greater than 50% confident that the IRS would agree with me in that answer. And even then, if we were to go to tax court, which knock on wood, no BGW client has ever gotten to tax court. Usually our worst case scenarios, we get something settled with the IRS agent's auditor. But again, knock on wood, our audits are typically zero adjustment audits, and we're known around town as pretty aggressive people. My point in saying that is these guys are going after fraudsters and criminals, which there are a lot of. Like there are people who literally, so I always laugh. It's like, when I have a client that wants to go buy a business, like, yeah, but this guy says, he gets a lot of cash receipts that he doesn't claim, and that should be considered as part of the value. And our clients don't do that, but there are a lot of people that do. You pay me in cash, you get price X. Well, when you get audited, guess what they do, Gary? They say, Gary, can I see your bank statements?
Mm-hmm.
And test number 1 is, I wonder what the sum of the deposits are relative to what's the sum of the gross income. And would you please explain the variances? That's who they're going to go after first. And, I think the people on this call, generally, they're like, that really exists out there? Yes, it really exists out there. Like every year we get a handful of clients that we have to, they're new clients to us. So we're like, hey, my CPA let me get away with this before. We're like, well, we're not. So we'll find other ways that are legal that we can be like, oh, okay, thank you. It feels good to come clean. I kind of knew it was wrong, but I didn't do anything about it. Like, no, we'll find ways to be legal. You not claiming cash receipts is not one of them. So that's that's who they're going to target. So like this whole they're coming after you. I think that's just a fear tactic that's just ridiculous.
So I want to make a comment because I see not all, the vast majority of new client stuff that comes in. And here's a general statement that I see. And I'll say this to prospects as well as clients, but in our world, there's a spectrum from I feel really guilty for being a capitalist, so I'm going to tape extra money to my quarterly payments, to here's the ethical and legal line. And usually most CPAs go towards I feel really guilty for being capitalist, because they want to be the most conservative, and they're high S, high C's on the disc spectrum typically. Well, so they will self-select. What I see all the time, they self-select into the most conservative options, and they never have the conversations in the spectrum of the legal and ethical, fully defensible. But if you're going to move in these more aggressive strategies, you better be buttoned up and you better have these things. That's typically where we find tons of money. It's usually multiples of our fees for our clients. But I think that's why it happens. And so I just echo what Adam is saying based on my experience of just seeing all this stuff that comes through. And I think we have a really great track record. And yes, we are known for being aggressive out there, but we are not going to push the ethical or legal boundaries. I can tell you that. So excellent questions. Really good discussions so far too. Anything else, Adam? As we're going into, first of all, before I ask this question, just to everybody, here's the deal. If you want access to the vault, it's behind a paywall. So if you are a BGW CPA client and you got a business, you have access to that vault for free. If you're not, we charge $2,800 a year for that. And it's not because we're just trying to make money. It's just because it's like, we don't want to give away our best stuff, and we want to actually treat our clients and give them preferential treatment. So here's the deal. If you're not a client or you don't have access to the vault for some reason, send me an email and I will get a 3-day pass for you so that you can go and check out some of the stuff that Adam's been talking about. So my email is gfreygfry at trustbgw.com, gfrey@trustbgw.com. All right. Next question though. Go ahead.
Yeah, I think so getting into kind of the fourth area where I feel like, okay, that's underutilized as well. There were also components of the Tax Cuts and Jobs Act that went, underutilized. And, one of the other big ones that we see is that, it used to be if you were, once you became over $10 million in gross receipts, you had to become an accrual basis taxpayer, which hit a lot of people pretty hard. It's like, wow, I've been a cash based taxpayer for a long time, and kind of did the usual, hey, kind of let's watch those cash collections at the end of the year and let's get some bills paid down so we can go get some deductions for it. And you go over $10 million on a trailing 3-year average, and all of a sudden it's like that ticket went away, and now I've got to pick up all that income that I've been deferring all this time through that strategy. Well, they raised that bar to $25 million. So that's big deal number one. Big deal number two is that what they also did within there is they also created some carve outs whereby even if you had to be an accrual basis taxpayer, which is generally going to be people that have inventory, they gave you some carve outs that still gave you cash basis like features. For example, if as part of your inventory process, you've got people working on stuff, and you're capturing the labor associated with them working on stuff in your work in process and your finished goods inventory, you can deduct that now. Literally the only thing you got to keep in inventory is the actual item original cost. That's big, because a lot of times that's 20, 30%, of whatever the inventory value is by the time it hits a finished goods inventory. The other one is, kind of taking advantage of the repair and maintenance regs, which is a lot of our clients, they have a big thing, like I use one of our clients that does ATM machines and cash machines and stuff like that. They've got a big thing that they've got, which is, real, it's inventory, but then they've also got a bunch of tiny spares and repair parts they got to keep around. Well, you can deduct all those too. So, that one is sort of like the Superman 3 scenario where it's like, yeah, those are only like $1-2 value parts, but I've got thousands of them of one SKU. And then I've got thousands of SKUs that are like that suddenly, off a $2-3 million inventory value, you find $300,000 or $400,000 that you can accelerate because those are allowable to be expensed. It's like that starts to become a big deal. That's a permanent deduction, for you. That is pretty cool. So we've done a lot of damage with that one too. Again, these are all things you got to be doing throughout the course of the year anyway, and just making sure your tax plan is optimized. But year end is definitely a good time to do kind of let's do an inspection just to make sure that we're where we ought to be.
Yeah, that's good. Any other questions out there? This has been a lively group today without Jack, man. So he's going to be very jealous when we give him the report. Actually, I think we should have given probably Matt the award for most questions. And also, was it Devin that came up with the pretty funny Congress and progress? That was Matt. Yeah. So Matt, yeah, I think what we're gonna have to do is next week you get back on here, and we'll have to tell Jack all about your insightful questions and your wit, and we'll see if we can get a Starbucks card out of him for that. Yeah, there. And I did get the chat turned on. Papa Joe, I don't know if I've seen you, but we got the chat turned on so Matt could get back to us. So that's good. So any other thoughts on, last quarter stuff that if you're not with BGW, what you should be asking your tax professionals to be addressing, or even moving into 2023 where you got a clean slate? What should you be doing to try to get your house in order if 2022 wasn't as orderly as you wanted it to be?
Yeah, good question. So I mean, especially as we're dealing with inflation right now, Gary, this is the decision that people should be making. This kind of goes back to the equipment purchase question, or, how much do I do in terms of tax deferral strategies, in general? Because inflation is almost kind of like a tax rate increase, it's just not passed by Congress. So if I was going, here's sort of my decision tree around, am I going to be, when I say aggressive, when I use the word aggressive, I mean specifically around deferring. Like, you should be aggressive on allowable and fringe benefits. You should be aggressive on everything that's allowed under the tax code. So I'm talking about those timing differences, meaning, using the tax code, I'm deferring the tax this year and electing to kick the recognition of the income into a future. I'm not getting out of the tax, but I'm electing to kick it forward. So when that makes sense is, I believe that there's going to be a tax rate decrease in the future, meaning like, hey, I can kick income into a lower rate environment. So we actually had a lot of clients that happened. It's like, we've been deferring Tax Cuts and Jobs Act passed. They just got a permanent 10% discount. on that income, do that tax rate decrease based on those deferrals that we'd established. And that was a lot of money for a lot of people that I chose to remind them about. I need a little brownie point in the Boatsman ledger on that one. So that's not us, so tax rates are flat. So at best, it's kind of neutral in terms of do you kick the can forward or not, because tax rates are probably going to be flat. Just keep your eye on the 2026 clock. The second reason to think about it is, I've got, cash is going to be really tight next year because I think revenues are actually going to be down for whatever reason. In that scenario, you really should consider deferring some income because you're going to have less of it next year. So if one of the strategies is, hey, let me go ahead and, pay down my AP as an example for stuff that I was going to buy anyway or have to pay for anyway, especially if I'm facing 6, 8, 10% price increases, that's like a double dip. One is I preserve cash going into next year because I didn't have to pay it out to the IRS. And then secondly, I bought the stuff at even though it's today's current price, it actually represents a discount if I had to buy it 6 months from now. So, that's another one to think about in terms of, hey, should I try to be aggressive on my deferrals or not? The third scenario is the investment scenario, which is, wow, I'm staring down the bullet of $100,000 tax liability. If instead I could hire a salesperson and that salesperson is going to generate, 4x their salary at my bottom line profit, blah, blah, blah. Let me go ahead and make that investment, in another person, because that's going to generate a return that's greater than, the potential impact of having to pay more tax in the future. Like absolutely, when I say absolutely, I mean in terms of absolute terms, I'm better off making that decision relative to just paying the tax now, because overall, even though I may pay that income at a higher rate, as long as the return is greater than the delta in the tax rate change, it was a smart decision to make. So that's another good reason to defer taxes. If your answer was, I just don't like the government and I'm going to keep the money in my bank account or shove it under my mattress, you need to get over yourself. You're an idiot. You're never going to face tax rates lower than they are today. You got to just suck it up and pay the damn tax.
Well, there you go. All right. Another question in from Bruce. Prepaying taxes or prepaying expenses in view of potential inflationary growth balanced against risk that prepayment to a business which may go bankrupt or be unable to provide the service. Is this a tougher assessment this quarter versus any other year?
Yeah, I think that, that's a pretty good question, Bruce. And, I haven't had any clients that are really faced with that, but obviously, that is a factor. It's like, look, if I'm going to pay this person, I better make sure that I've got enough hooks in that, I can get it back if I need to. So like, what would be a scenario where even though I could get a tax benefit for it, I might consider not prepaying? Well, I mean, if you used your home remodeling repair, not that's tax deduction, but if you were to use that, there's no way in hell I would ever pay my residential home repair guy in advance. I don't care who they are. But in the world of, our businesses, who would I not prepay? Probably somebody that was doing a technology implementation project for me, I would not prepay, even if I could get it, even if I got a discount and a tax deduction for it, because those kinds of projects are notoriously awful at missing implementation deadlines or otherwise, making me, very, very upset with what they ultimately end up delivering. So I think you got to weigh it in terms of, do I need to be keeping the money as a way to ensure that I'm going to get service? And if the answer to that is yes, don't pay that one. If the answer is, look, these people are pretty stable, predictable, we've had a good long-term relationship, very little risk here. Yeah, pay those.
All right, good questions. A couple people raised hands. I've sent chats to you. If there's anything that you want us to address, just hit us in the Q&A and we'll be happy to answer your questions. What I can say is you've gotten a lot of really good advice from the wizard, man. So, but that's why we're here. That's why we started this 135 weeks ago. And Lord willing, we plan on being back next week and doing more of the same. So what we do want you guys to do is we want you to finish 22 strong, everything that you can do. Oh, another good question. Any new stuff on R&D tax credits?
There's not anything new. It was just made permanent.
All right. If you do own a business, and I mean, if you do own your building and you haven't looked into cost segregation studies, Google it. We can help you with it. Or there are other folks out there that can help you too if you're not a client of ours, but that's something that we do a fair amount of stuff with. And basically it just accelerates depreciation in various aspects of the building. And we owned a commercial building in a company that I was in, that I was a partner in, gosh, and we did a cost segregation study in 2005 on this commercial building, which that was really early, and we did get audited, and because it was so new, but we passed the audit. But it really did help. So it's another cool little trick that you guys can use that's there for the taking. Adam, anything else as we are rounding the base to hit home?
No, we're good, baby.
All right, last call on questions for you guys. You guys have kept us hopping. It's been good. And we don't even have any Jack dad jokes to fill the last couple minutes. So I'm ringing the bell.
That's right, man. Let everybody have an early lunch.
So, all right. Well, I hope you guys have a wonderful rest of the week. We appreciate you taking the time out of your day to join us. And we'll be here next week, Lord willing, with bells on and with the Jack Centinelo. Oh, here we go. One more question just under the wire. Oh, thanks always, gents. You bet, Derek. Thanks for being on. We appreciate it.
All right. Thanks, guys.
Have a good one. See you. Bye-bye.
Bye.